All right, today we're going to talk about the original research and commentary and also the best articles that we came across this week. And we highlighted on the Guru Investor blog for February 12th, 2021. And to start, Jack, I'll let you talk about your article on the basics of value investing.
Yeah, this is part of a series where we're going to go through all the major factors and talk about why they work, what the individual metrics you should use are, just basically a top to bottom look at each factor. And we started with momentum about 2 weeks ago. And, so we got a chance to talk about the outperforming factor that everybody wants to follow right now. And so now we're going to go the other direction. Now we're going to talk about the painful factor that nobody wants any part of right now, other than the past 6 months where things have gotten a little bit better. But so I talked about value investing and I talked about why value works. I talked about some different metrics you can use to build a value portfolio, looking at a composite of a variety of factors versus using individual factors. And then I also talked about how you can combine value with other factors. Value is a factor that works very well with other factors. You can combine it with quality and try to use sort of a Warren Buffett approach where you buy high quality companies and try to buy them at a discount. You can use negative quality where you try to find really cheap stocks, but you try to filter out the absolute worst ones, or what many people would call value traps. And then value also works pretty well with momentum. So I looked at that as well. You can use value and momentum are probably two of the most uncorrelated factors. So when you combine them together into a portfolio, you really get a free lunch. You get the benefit of two factors that have had excess returns over time, but that tend to outperform at different times. And also momentum can be used sort of as a signal of when to get in on a value stock. So a lot of these value stocks will stay out of favor for a long time. And so some people will use momentum as a way to say, all right, it's time to buy this value stock now because things have turned up as they have recently. So they work well in conjunction that way. And then finally, I talked about some critiques of value and some reasons you might not want to some reasons you might not want to follow value. One of which obviously is what we've seen in the past decade, which is that value can underperform for a very, very long period of time. And it can be really hard to stick with when it is underperforming. So anybody who's invested in value in the past decade doesn't need me to tell them about that. But that's one of the major critiques of value, is that a lot of its outperformance comes in very short periods and a lot of its underperformance can happen over very long periods.
Yeah, I thought it was a good article because it's good to kind of take a step back. Sometimes we're sort of in the weeds and sort of, come one level up and try to help, investors that are maybe new to investing or that they understand what value investing is, but, they want a little bit more detail and try to give like a value, 101 course, if you will. So I thought that was a good shot at that.
Yeah, and it's really important. If you're going to follow factors, it's really important to understand what it is you're getting into, because there is a lot of, most people should just buy index funds because factors are very difficult to follow. They have long periods of underperformance. So it's important to understand what you're getting into. And it's also important to understand the best way to use that factor to construct a portfolio, whether it be the metrics you use to select the stocks with the factor or how you combine it with other factors. And so I was trying to take a high level look, just maybe to look at all of that. So anybody who's thinking about following a quantitative value approach might have all that, in one place to take a look at as they make that decision. What was our podcast this week?
So yeah, we highlighted the Joel Greenblatt investment strategy, specifically the magic formula, which is a strategy that he wrote about in the little book that beats the market. In the podcast, we actually talked about the criteria that go into that strategy, which is the earnings yield and return on capital. And then we discussed sort of how the strategy is formulated with ranking stocks based on those two things and then sorting. We talked about Greenblatt and his background, how he really does a good job of making, these investing concepts understandable. And then we sort of wrapped it up with talking about our own experience in running our version of the magic formula in terms of sort of some of the performance behind it and, what we've seen out of that model over the past 15 years or so. So it was, a lot of investors know Joel Greenblatt. He's kind of up there in terms of being one of the famous value investors. But when he was running his hedge fund, Gotham Capital, during the 80s and 90s, he achieved what were like phenomenal returns. And so that kind of put him in this category of great investors. And he's a pretty prolific writer as well, published multiple books on investing. So it was really an article about Greenblatt. And what we're trying to do is once a month go into one of our strategies that we run on Validea. Many are based on great investors. They're not all based on great investors. Some are based on academic papers or other books, but trying to do a deeper dive into those strategies to help educate as to what goes into these models and how they work.
Yeah, and the Greenback strategy is an interesting one from the perspective of it really gets at what you want to think about as an investor. You want to think about buying good companies, and you might want to think about acquiring those companies at a good price. And so, if you think about the two things that investors should think about, this is a great system that combines both of those together. And in the podcast, we got into more detail about the exact criteria, but it's a good way of thinking about the way you might want to analyze a company. Now, but having said that, one of the things Greenblatt gets into in the book is that no investment strategy outperforms every year. And so he spent a lot of time talking about, although this makes a lot of sense, though I have shown great results in this book, there are going to be extended periods where this doesn't work, and most investors probably won't be able to stick with it. And so I think those are two important points. One is what you should look for in a company, but two is no matter what you do, you're going to have periods where you underperform, and you're going to have to be able to stick with your strategy during those periods, or you won't realize its potential. What
article stood out to you as being sort of top of the best?
For me, it was a Wall Street Journal article. It was called "Why Investors Should Not Try to Time the Market." And what I thought was interesting about this article is, first of all, we all know we shouldn't try to time the market. There's nothing groundbreaking with that. But what they found is that when investors, one of the reasons investors try to time the market is they try to get out during the declines. And so they figure if I time the market, I'm going to have less losses. I'm going to have a less volatile portfolio. And what they found is the exact opposite of that in this study. They found that investors who try to time the market actually have more volatility in their portfolio. So I'll read a thing from the article. It says, active investors tend to chase stability by attempting to minimize volatility in their market timing efforts. They end up doing the exact opposite. The researchers found that the volatility of the actual investor experience is nearly 50% higher than the corresponding volatility of stock returns, and further that the volatility grows over time. So I thought that was really interesting that we all know we shouldn't time the market, but even the reason we're trying to time the market, which is to reduce volatility, even if you take away the return part of this, where you're trying to achieve better returns by timing the market, you're not doing anything. You're not achieving better returns, and you're not achieving better volatility either. It's really a lose-lose situation.
Right. So not only have you hurt your performance and your investment accounts basically, but you're adding to the level of risk that you're taking. So it is, again, it's another reason why most investors, the vast majority of investors, should not be trying to time the market, but it's always very tempting. It's a lot of people, and it's hard. It's hard to resist that temptation, whether you're in a decline, trying to get out, you think things are going to get worse, or even in a period like we are now, where the market looks kind of expensive based on most metrics, and some investors are probably asking, like, do I take money off the table? Do I reduce risk a little bit? So I don't know. It's just, but effectively, it's another knock against market timing.
Yeah, it's something we already all knew, but I thought that it was a different take on it. Thinking about, you're trying to time the market to reduce volatility, but you're actually getting more. And, so that was, to me, a take I hadn't seen before on market timing. What was your article this week?
Yeah, so it was an article in Advisor Perspectives from late January. It was an article that we highlighted just recently, though, and it was from Larry Swedroe, and it was titled "The Battle of Factor Models." And in it, it's a kind of a shorter article for him, but he basically kind of starts out by saying, we started with the capital asset pricing model in terms of explaining the cross section of stock returns. We then moved to the three-factor Fama-French model, then to the Carhart four-factor model. He actually mentions Lu Zhang's Q-factor model in here. And then he's kind of basically saying that we shouldn't be surprised that all these new models have come to fruition over time, because it's actually, they're all helping better explain the returns that stocks and certain types of stocks sort of achieve over time. And then he kind of pivots and goes to this study that was put out in March of last year. And the title of that study is A Comparison of Global Factor Models. And what these researchers did is they looked at 50 non-US developed and emerging market countries, and they basically tried to identify within those markets, what were the factors driving market returns. And they found that, the highest average return actually came from momentum, and that was followed by two value factors. The size factor actually wasn't that effective in these markets. They found that, the pattern in the U.S. market is largely what you find in these other markets. And so there's a bunch of other sort of findings here, but sort of the summary is that, these guys are finding the same types of things that we're finding in the U.S. market, but that these models are likely to continue to advance. So as we go forward in time, there's likely to be other findings about the drivers of stock returns. It's not like these models have and these studies sort of exist and then stop. And what I find interesting with that is it's the same when we talk to people like Jim O'Shaughnessy, or even, we're a little different, but the point is that these models continue to develop. They continue to find and uncover new things, especially when you look across markets and across sectors and things like that. So anyways, it was a good article. We'll put a link to it in the show notes.
Yeah, I think this is something that's, like you said, is going to be going on forever. I mean, if you take a step back to the beginning, I mean, what was the first model we sort of looked at? It was CAPM, it was the capital asset pricing model. And it said, and the question we're trying to answer with these models are, what are the risk factors that drive stock returns over time? And we started in CAPM with beta. And then it became pretty clear that CAPM doesn't hold in the real world. And so then we advanced to, we added size and value, and then, we add momentum, and we add profitability. So, you can just continue over time. I'm sure we're going to continue to add factors as academics do more research and we try to learn more about what drives stock returns. So we should expect that, what we're using right now, what we think the best models are right now, a decade from now, we probably won't think those are the best models anymore.
Yeah, good stuff. Okay, guys, thanks for watching this highlight video, and we'll see you next time.
Thank you.
If you'd like to keep up on the research, writing, and curation we're doing at Validea, please go to blog.validea.com to learn more and stay updated. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonneau. Thanks so much.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.